Hey everybody, this is Jose. We are about to get started. This is my quick hello message, as always, asking for a quick sound check. A quick message on the chat box would do. So then if I see that message on the chat box, it means that you heard me, and I know sound is good for us to get started with the session and begin our options trades. So please go ahead and type something nice in the chat box, which is nice and confirms you hear me well. Thank you so much. In the meantime, as always, I will turn on the video stream. Okay, so hey, I can say hi here from my corner on the bottom right side of the screen, and we are 15 seconds to go before the session begins. So please, confirmations, quick hellos, that would be greatly appreciated. Thank you so much. Very nice. Cool, that's it. So we just hit the top of the hour. I can see some confirmations here. This is beautiful. Thank you so much, everybody. Welcome, everybody. Today is November 4, 2021. My name is Jose Blasco. The session is Options with Options. So the plan is obviously to explore the opportunities in the options markets. And we do it in a different way because we look at the market, we look at the positions, we look at new trades to be executed. So we look at different angles. Before we get started, disclaimer, you can see that on the upper left side of your screen. So please read it carefully, read it entirely. I am counting on you to read it completely. It is indeed important information and is being highlighted for you. Jeff, how are you? Maka, everyone, good to see you guys. Very nice, very nice. Okay, so agenda, we're gonna look at the current market environment. We'll review the trades that we have. We'll talk about trade management. We'll have a mini lesson today on assignment, exercise, and things like that, which are extremely important. It's going to be mini lesson, but it could be 20 minutes, 30 minutes. I will see. But while it's a mini lesson, it's absolutely critical. Okay, so make sure that you are ready to take notes. Listen carefully, even though this is recorded, and you can always listen to it again. Okay. Anyway, so. We have the special question page that I always like, and I'm getting into the routine of showing you this every session so you guys don't miss it. tradewithufos.com/ the name of your coach, in my case, Jose. That would be the link you want to use when you have questions, so you can get here to the questions and answers section where you can post your question, title, description, insert images, pictures of the charts, option chain, risk graphs, whatever that is. And those questions will show on the bottom part, so then you get your answers there. And also, by the way, you can search for other questions that have been, basically posted before from other users that are indeed very interesting. Okay, cool. So here we go. Let's get into top right here. And let's begin our session. Questions here, comments. Christian back from Moving Chaos. I could understand how chaotic that could be. So I guess that, you probably feel good but exhausted. So you have this tired, smiley face. I could understand that. Maka, here's my summary. So far, I only see the word exercise. So I guess you are going to be typing some more there, Maka. So I'll be looking at that, okay? You cannot paste it for some reason. So maybe you have to do one line at a time. Try that if that's the case. Okay, so in any case, so the S&P, what's going on? Well, incredible market conditions. We talked about it yesterday. I'm just going to be very quick today because we did a proper market analysis yesterday. The conditions, to be honest, are exactly the same, but one difference. The one difference is that implied volatility for the calls now, it's slightly higher than the puts. Yesterday, it was exactly equal. So it seems that even though this move is absolutely unbelievable, it's beautiful, incredible, crazy, not probable, away from what probability suggests at any level, but it's happening, it's true, it's real, don't fight it, okay? Well, while all of this already happened and buying now, maybe buying way too high, the reality is that from behind the scenes, you can see how the calls are winning against the puts. The blue line against the gray line is winning. And when we look at the volume map, so now we can see more calls, more calls, more calls, more calls with multiple expiration dates above the average, above the average, above the average, above the average. All of these, my friends, unless something happens before the close today, all of this is the recipe for continuation. Okay, so, but at the same time, continuation It doesn't make sense from a statistical point of view. So again, my plan today will be exactly as I said yesterday, to look for long and short. So we don't have a strong bet in any direction, because if you were to make money in any direction you bet, there is a component, there is an ingredient of luck, in the sense that the market is more likely going to fall, but that's for many days already, and it kept going, and vice versa, it could be the case. So we are not in a situation to bet too hard in one particular direction. Of course, with such bullishness, the VIX is being crushed 15.36%. So again, lower implied volatility for the option. So it's okay. We'll play the directional moves, and then if we have time, we'll look for non-directional plays, as I said yesterday. Good. Review of positions. So we have CL that we discussed yesterday. Pfizer, we discussed that yesterday. Pfizer is open, so it doesn't hurt to have a quick look at Pfizer. So Pfizer today is down by 1.8%. Okay, so it's not been moving as well as we thought. You may remember that yesterday we placed an order to close those calls at 5 cents. The bid is 5, the ask is 6. So have we got filled? Not yet. So 0.5 is our limit order to close those 48 calls. The last traded price was 0.65. So we are getting very, very close to 5. We may get filled during the session today, and those calls would be gone. Okay, so if you recall yesterday, I used the term, I just made up a term, to be honest, but it's very visual, I would say, which is to have a trade management style, which is a strangling management style, in the sense that if the market was to go down, you were going to sell calls. If the market was to go up, you were going to sell the bull put spreads that were below price. So it's going down. So we are about to get ready of the 48 call. So we'll see if that happens. With KBH, really not too much to comment. This trade is not working well at all. KBH, the risk is totally under control, so not an issue. But that market keeps going higher, 1.08%. That stock was supposed to fall and just kept going higher and higher and higher. We are still in that Elliott wave turning point. We haven't broke that dotted line, so it may still fall, but so far it's not. Okay, so what can we do with this trade? Well, if you take a look at KBH at this moment in time, it was converted to an iron butterfly let me rephrase that, a directional butterfly, where we used to own the 39 put, okay? And then notice that, we sold another 37, we bought at 35, and those two units that we sold, okay, they are, the trade price is 20 cents. How come the mark is 20? Let me see that again. The 37. Oh yes, I didn't look at the 5. Oh, got you. The spread is very wide. Okay, I got confused for a moment. I was looking at 5 and 6, and this is the number I should have looked at. So 35 is the ask, 5 is the bid. Okay, so there are people already willing to buy those back at 5 cents. I would want to do that myself. It doesn't look like we're gonna get filled with such a wide spread, but since we are not gonna meet until next Wednesday, and many things could happen from now until Wednesday, so I'm gonna do the same thing I did with Pfizer yesterday, where I placed an order to close those 2 calls at 5 cents. In this case, it's not gonna be 2 calls, it's gonna be 2 puts. Okay, so I'm gonna right click to create a closing order to buy back at 5 cents. Okay, with good till cancel. Okay, and I'm just gonna place this order to get rid of those options. I won't look at the risk profile because it's copy paste of what we saw yesterday, and I want to make time for the mini lecture we have today, and ideally some trades too. So I won't go into the risk graph with KBH, but I guess you get my point. By closing the short units at 5 cents, so you are leaving 5 cents of credit on the table, but now you become so much more directional. So while the stock has been going up, which is again what we wanted, so if the stock now was going to fall, now you're going to have double the amount of puts profiting to the downside, which may make up for all this wasted time lost with having the stock go against us. So we want to get rid of those 2 options. At 5 cents, it's a fair decision. At least is one of my rules. And here we go. We have it right here. Buy back the two 37 puts at 5 cents, good till cancel. So whenever that happens, we'll take it. It could be tomorrow, it could be next Wednesday, it could be whenever that is. That order is good till cancel. So it will execute if the market gives us this price. And then we got COF, which today is moving higher a bit more. So we can see a bit more profitability. So let's go ahead and take a look at COF. Okay. Well, actually, no, it's not going higher. Actually, it's going lower, 75. But I guess that because implied volatility went down, actually the profit. Let me look at the midpoint. Okay, yeah, I was looking at, I didn't refresh this properly. Okay, so the midpoint is $4.14. It fluctuates depending on the spread. So yeah, so that stock is doing a little bit of a retracement with 0.76% down. And therefore, we see a little bit of a lesser P&L compared to what we saw yesterday. I was surprised there. So, in this case, we cannot really act on this because, we need that market to go higher to be able to either get rid of the put side or work on the call side, converting it into a spread or doing whatever other management that we have done before, but we cannot do it now because that stock is still basically more or less where our entry was. So we're going to leave it alone, okay, for now, and we will revisit this trade next week. I'm not in a rush to reviewing this trade. If you remember, the expiration date with COF was January 22nd. So, I mean, we are giving ourselves plenty of time. So it's not like Pfizer, where the expiration date is November 19, where if you're going to act on it, you better do it soon. But with COF, we got plenty of time, and therefore it's not critical for us to do anything at the moment. So this is my review of the positions that we have in the system. And what I would like to do now, and this is, of course, it's coming, it's very needed out of the experience that we acquire with this trade with Colgate Palmolive. We need to run our mini lesson on assignment, exercise, and then specifically apply to this trade, look into what it is that happened to this trade and what were the right actions to be taken, and learn from it and be ready to participate, because I want to quiz you a little bit, guys, there, because I don't want to simply just give you the lecture and that's it. I want to make sure you guys are with me. So you're going to have a few questions, so be ready to answer. Remember, there is some video lag at times, so be ready to act on that chat box so we can be efficient with the use of our time, okay? And also, apart from talking about assignment and exercise, I remember that some of you, to avoid assignment or to mitigate the risk of assignment, I should say, you guys got either long or short shares to offset what was going to happen with the assignment, things like that. So we need to talk about that too. I remember your question yesterday, Mark. I hope you're ready to repost it today. But before I get there, I want to talk about exercise and assignment separately, so it's well understood, and I'm going to quiz you a little bit, okay? So you guys ready to work with me? This is question number 1 of the day, by the way. You guys are ready to work with me, okay? Give me an answer so you prove that you are listening, okay? I know you are. Okay, so let me take a look at the chat box in case I'm missing something. Stock below or above the short strike is either assignment or exercise. That's what Maka said. That this is correct. To avoid either buy shares or buy a call if below the short put. This is no, this is not correct. This is not correct. You got that one backwards. So we're gonna talk about it. Or sell shares or buy a put if you are above the short call. No, you got that one backwards, Maka, which makes sense because the other one was also backwards. Not an issue. I'm going to repeat it. I'm going to make notes on the screen. If I need to slow down, you guys slow me down. Okay. By the way, I didn't get any response when I asked you, are you guys ready? No response from anyone. What does that mean, guys? Come on, just give me, I know it's an easy one, but give me a sign of participation there, okay? Maka, stock between the short strike that expiration equal profit, price at exactly the short strike that expiration equal max profit. That's correct. No worries for the typos. Okay, Maka, I'm gonna re-explain the whole thing. You will understand it, not an issue. Joe, short options in the money equal assignment. Very good. Very good. Christian is ready. Perfect. Wonderful. Perfect. Okay. Let's begin. Okay, guys, let's begin. Again, and this is, in one hand, this is a very basic subject because normally in very initial stages of almost every single options course, that's when, courses will typically talk about assignment, exercise, all those things. And in that sense, it's very basic stuff. In the other hand, what happens is that because normally this is covered in very early stages when an options trader doesn't fully understand options yet, then you get into spreads, you get into iron condors, and you kind of forgot everything about assignment exercise. And then it becomes very confusing, where the reality is that it's very simple if we go back to the basics. Okay, so this is what we need to do, because the rules for assignment and exercise, no matter how complex your options position is, like for example, in this case, Pfizer, look at that, how many options we got there, right? How many legs? It doesn't matter how complex your position is, the rules for assignment and exercise are always the same, like if you only had one option. Okay, so we need to talk about that. Okay, so first of all, there are two concepts to be understood. One is assignment, and the other one is exercise. They are the opposite of each other. Okay, and by the way, I'm talking about this in the context of American style options because we are dealing with US markets. Almost every single tradable market in the US is American style options. But careful out there, I know some of you trade SPX options, or you may trade options on futures. So careful, because then that's European style as options. And that means that everything is cash settled. So even if you get a sign, you don't get put shares, you don't get called away shares. Everything is, whatever monetary result of that assignment would be is then cash settled in the account, and you never get assigned either long or short shares in your account. Okay, you get the net monetary result of if you had been assigned and closed the trade, but you don't get the shares. Okay, so that's what is called European style options, which are rare in the US market unless you are dealing with indices and things like that. When we talk about options on stocks, it's all American style. And American style means that, first of all, if you get assigned or you exercise, you get the shares. You get the underlying asset, either long or short. But second, when it comes to the exercise, which that word can be read in two different ways. So exercise is something voluntary during the life of an options contract. So let's say you buy an option that expires 2 years from now, and you choose to exercise now. Because it's an American style option, you can do it. And then you get the shares, either long or short, depending if it's a call or a put. If it was European, you cannot. You need to wait until expiration. Okay, and on top of that, most of the cases they will be cash settled. But because it's American style, you can exercise whenever you want. Okay, so because you can exercise whenever you want, many traders think about exercise as it's a choice that you can make if you want to do it or not. And that, my friends, it's true, but ceases to be true on expiration. So on expiration, okay, no matter if you bought options and you have the option of exercising, or you have sold options and you are subject to maybe being assigned, okay? Well, on expiration, if your contract, call or put, is in the money, even if it's by 1 penny, 1 cent, one whatever, you get either assigned, and that everybody understands, but you also get auto-exercised, okay, which exercise during the life of the contract, it's something optional. Well, it's not optional anymore on expiration if the options contract expires in the money. Okay, so in other words, when you are basically driving an options trade all the way to expiration, you need to be careful with both the assignment and the exercise, not only the assignment. Assignment is kind of like it's a word some people are afraid of. Okay, I particularly, I just know that assignment exists and there is nothing to be afraid of in my mind. I mean, if you get assigned on a put, you are long shares. There are millions of stocks traders in the world that get long shares just by buying stock. So being assigned means now you are long stock. What's the issue? Well, as long as you know their prices, you have stops, you understand the trade plan. So it's not like you sold 1 million puts, you got assigned, and now you don't even know what you're doing, and you got the whole account exposed. That's called gambling. But as long as you are applying the rules that we are learning, you have a business plan, you are disciplined, I would say there is nothing to be afraid of assignment, as long as you know it's going to happen. Now, with exercise, many people don't realize it's going to happen on the expiration date. So, my friends, keep that in mind. Assignment happens on expiration or before. If someone exercises the option, you are on the other side, you get assigned. This could be on expiration or before. Classical case is before dividends. Some people want to exercise calls so they get the stock shares, so they get the dividends. So if you are short calls, you may get assigned early before the expiration date, right? But on expiration, for sure, you will be assigned if the option is in the money. And same happens with the exercise. You will not be exercised, you will be auto-exercised, okay? Exercise is something that you initiate, but being auto-exercised is something that happens on expiration when the options contract is in the money by 1 cent or more, okay? So, please, confirmation. Everybody with me with what I just said. So, while you're typing, I'll summarize it one more time. Assignment is what happens when you sell options, calls or puts. Well, I should say, not what happens, what may happen if you sell options, calls or puts. Exercise is something that you could choose to do if you want to during the life of an options trade for calls and puts. But on the expiration date, if the option is in the money, just like assignment would happen, auto exercise would also happen for both calls and puts. Okay, so everybody with me so far, based on what I can see on the chat box. Thank you so much, guys. And again, I want to persist and I want to insist, please participate with me on answering those questions, because we had multiple sessions talking about assignment exercise. And I know I've just been sharing so much with you guys that there is a moment in time where sometimes in life less is more. So maybe it gets confusing, and I know it does sometimes. So we are reviewing something critical, but if possible, I would want to not to have to review assignment and exercise until much, much later in time, because I got more plans of more things I want to teach you. So please work with me on this session today. So when we close the chapter of assignment and exercise, we all have the peace of mind and this is well understood, okay? Thank you for that. So now that we know assignment and exercise is now that assignment, exercise, and auto exercise is clear, the next thing I want to discuss with you, and again, it's going back to the basics, is what's in the money. Okay, and you're gonna be like, seriously, Jose? I know what's in the money. Okay, I know, but let's have a healthy review. So what's in the money, right? And that depends. Okay, in the money doesn't mean profitable. Okay, so if you're new to options trading, a classical confusion is that you think in the money means the option is profitable. Doesn't need to be. Okay, so if you buy an option, if you buy the 50 call, okay, and you pay $2.10, right? And on expiration, that stock, it's trading at $51. Okay. So what happens? Well, on expiration, the value of the 50 call when the stock is trading at $51 per share, okay, the value of that call will be $1. Why? Because it's the difference between the right to buy the stock, which is 50, and the current price at expiration, which is 51. So you get $1 of what's called intrinsic value, and therefore on expiration where there is no extrinsic value left, so then the value of the option is 1. So you bought the option at 2.1, you sell it at 1, well, you lost money. In a case like that, you would have lost money. This is not a profitable trade, but having said that, the 50 call when the stock is trading at 51 is an in-the-money option. It's in the money, meaning it has intrinsic value, meaning the stock has moved in the right direction past the strike price by whatever amount. Okay, the stock has passed the strike price by whatever amount. Now, of course, when it's a call, you want the stock to pass the strike price to the upside. When it's a put, you want the stock to pass the strike price to the downside, and then the option will be in the money. And by the way, and here's another question for you. So we said the 50 call is in the money if the stock is trading at 51. Okay, so please answer the question in the chat box with number 1. Add a number 1 on the chat box, and then you type, yes or no for you to confirm that you understood or you haven't. So the 50 call, you buy the 50 call, and when the stock is trading at 51, the 50 call is in the money. Okay, so question one, yes or no, agree, disagree. So one, yes or no. But now number two, okay, number two question is, what if instead of buying the 50 call, I sell the 50 call and the stock is trading at 51 on expiration? It's the same 50 call. The prior case, you buy it, okay, and I can see your responses. Your responses are one, yes. Thank you very much, Mark. So you got it right. But now, question number two, which I would like you to answer with number two, is what if I sell the 50 call and the stock is trading at 51? The question number two is the short 50 call in the money when the stock is trading at 51? So question number two now, is it a yes or is it a no? Okay, I'm gonna take a sip of water and wait for your answer, because this is critical for me to see those answers. Please, everyone, go ahead and give me a bit more participation. I need to see your answers, okay, guys? So Joe says yes, it's in the money. Okay, I need to see more answers. And Joe, I see your question there about the break-even. I'm coming back to you in a moment. Mark says yes. Maka says yes, exactly. So why is it that the long call is in the money and the short call is in the money? Well, because the concept of in the money, and therefore the very important consequence of being assigned or being auto-exercised, so the concept of being in the money does not depend on the plus sign or the minus sign. The concept of being in the money refers to the contract. The contract is in the money or out of the money. There is no, again, in the money doesn't mean profitable or non-profitable. In the money doesn't mean you are positive delta, bullish, negative delta, bearish. In the money means there is intrinsic value. So if it's a call and the stock went up above the strike price, it's in the money, even if it's 1 cent. If it's a put and the stock went below the strike price, it's in the money. No matter if you buy or you sell the put, if the stock went below the strike price, that put is in the money. Okay? So this is absolutely critical for you to have it in mind. I can see all the answers were right. Okay? All the answers were right. So I'm happy to see that. Okay? So when you buy an option, when you sell an option, being in the money or out of the money does not depend on you being a buyer or a seller of the option. Okay? It depends on where's the stock. Okay? So, mini quiz. You own the 25 call and the stock is trading at 21. Very quick on the chat box. Speed of the light. Is that call in the money or out of the money? So please type ITM or OTM. ITM or OTM. You either buy or sell the 25 call. It doesn't matter if you buy or sell. The stock is at 21 on the expiration date. In the money or out of the money? That's the question. Okay, 25 call. The stock is trading at 21. In the money or out of the money? It's out of the money. Okay, it's out of the money. Why? Well, another way to think about it is you got nothing to brag about if you have the 25 call, right? Because the 25 call gives you the right to buy the stock at 25. Why would you want to do that? You can buy the stock at 21 now. It's lower. That call has no intrinsic value. That call will expire full worthless because it's not going to do anything good to your account because the stock went against it. When it comes to the intrinsic value, again, I'm not talking about you bought it or you sold it. If you sell it, you're making money. But I'm not talking about that. I'm talking about the intrinsic value built in that contract when the stock is trading at 21, which is 0, therefore is out of the money. Okay? Now, what if instead of the 25 call, you own the 25 put and the stock on the expiration date, the stock is trading at 25.01? So same question, in the money or out of the money? in the money or out of the money. And yes, Maka, you're right. If the stock was 26 on the prior case, that would be in the money. So now question, you have the 25 put, long or short, it doesn't matter if it's long or short. You have the 25 put. The stock is trading at 25.01 on the expiration date. Is the 25 put in the money or out of the money? Think about it from this angle. Do you have anything to brag about? The 25 put gives you the right to sell at 25. The stock is currently trading at 25.01. What's better? To sell at 25 or sell at 25.01? Do you have anything to brag about? No. So it's out of the money. Very good. Good question. Good question. Okay. Now, what if you have, let's do one more example. Okay. Because I think you guys are getting this. Okay. Okay. So Maka, if you own the 25 put, okay, and on expiration date, the stock is trading at 24, do you have anything to brag about? Is there any intrinsic value? Yes, $1 of intrinsic value, right? Because the 25 put gives the right to sell at 25. The current price at which stock traders could sell is 24. So you owning the put, you can brag about, hey, I can sell $1 more expensive than you. That contract got that extra $1 value. That's the intrinsic value. Okay, so it's in the money. Okay, so Maka, you're right. 24 would make the 25 put in the money. Okay, so last example. So let's say you have the 98 call and the stock is trading at a beautiful Fibonacci number 89. So question, is that call in the money or out of the money? Okay, just wait a moment. Thank you for your participation as well, Nick Nack. Okay, just waiting. Again, the natural, since we are simulcasting, so obviously there is always a little bit of video lag. Very good, guys. Very, very good. I tried to trick you and none of you fell into the trap. I love it. Thank you for your attention, guys, because notice what I've done. I wrote 89, which is, if I do it graphically correctly, 89 is below 98, isn't it? But I just put the 89 above to kind of trick you to see if you were going to react to the thinking process. And I love how you guys did very well, because you thought about, if the stock is currently trading at 89 and I have the right to buy that stock at 98, do I have something to brag about? And the answer is no, because it's cheaper to buy at 89 than buying at 98, even though my drawing was incorrectly placed on the upper part of the screen. It should be on the bottom part, okay? Got it. Perfect. I was looking for this moment. I was thinking about this question earlier in the day. I wanted to make sure you guys got it. Because again, the thing about this is that when you have to take certain decisions about options trading, then it's you on your computer and you're sitting there at home on your desk, maybe in a Starbucks. And basically it's that moment where it's you and what you see and your, assessment of the market data you have in front of you. And it's very easy to get confused, okay? Because, in the end, it's easy to get confused. Plus, we are human. It's easy to make a mistake too. So I just wanted to add a little bit of trickiness, if you guys don't mind, in that question style to get you thinking. Okay, so now, recap. If options are in the money, they will be subject to either assignment or auto exercise. When options are out of the money, then they expire worthless, and then there is no assignment and there is no auto exercise, because there is nothing to brag about. So then nothing happens to that options contract. Okay, it's just like You bought an insurance policy to protect your car, and then you didn't crash the car, and then the insurance policy expired. So what happens? Well, it's over. You never got to use that contract for anything because you didn't have an accident with the car, right? So, well, in this case, it's a happy moment. In trading, sometimes you actually want to be assigned or auto exercise. That means the stock move your way or not, depending on being long or short. But the concept is, in the money, you are now subject to assignment and auto exercise rules. Out of the money, you're not. Okay? So all of this concern and the reason for our conversation today, which is all about assignment exercise, remember, it only happens when your options are in the money on the expiration day. Whatever options you have are not subject to that. For example, if we look at the trade that we had with Colgate-Palmolive, okay, where let's load CL. So on CL, let me get to a daily time frame, okay? On CL, on Friday, when the market closed, that was right here on the 29th. So the closing price of that stock was 76.19, okay? That was the closing price on Friday. If I got the right dates, yes, October 29, that's correct. So 76.19, let me write it down, okay? So 76.19, that was the closing price on Friday, October 29, okay? So we're gonna put that here, okay? So we have that note there, so it's in our mind. So now, as we keep this in mind, the other thing we need to now write on the screen is, what was this trade about? So this trade was made of owning an 81 call all the way there on the top, okay? Then below that, much below the 81 call, as you can see here, okay, we had the 78.77 call, okay? So we had 78 call, we had 77 call, and there below we had 77 put and 76 put. Okay, and now if we look at the quantities, because the quantities were actually something quite critical, let me expand this. So the quantities were, the put were 2 of each, and then on the call side were 2 of the 77s, okay, and 2 of the 78s. So 2 of the 77s, 2 of the 78s. Let me do that again. So when it comes to the 78s, we got 2 of the 78s. When it comes to the 77s, we got 2 of the 77s. When it comes to the puts, we got 2 of the puts, and therefore I got another 2x there, okay? So yes, so that's the trade that we had, okay? So we had everything 2x when it comes to the bottom part of the screen, and we got a lonely 81 call all the way on the top. And this is the product of the positional evolutions that we did. Now, just to remind you, if you remember, this thing here, that's an Aron butterfly, okay? You buy the 78, sell the 77 call, sell the 77 put, and buy the 76. That's an Aron butterfly, okay? That's an Aron butterfly. And then we had a lonely call, there all the way on the top. So, knowing our position, and now knowing that the closing price on Friday was 76.19, first question I would like to ask, and please be ready to participate, is what happened to that call? Was it in the money or out of the money on Friday when the market closed? So what happened to that call? Was it in the money or out of the money? Okay, so please give me an answer to that. That's the first thing you need to do, right? When you are looking at what am I going to do, because expiration is 1 hour later. So what am I going to do? What am I going to do? Hopefully you plan ahead, not 1 hour before the close, because that's the recipe for trouble. But whatever it is. So when you're thinking, what am I going to do? So the answer, it depends if it's in the money or out of the money. And therefore the question was the 81 call, okay? And as you can see, the 81 call was out of the money. Everybody said it right. Okay, why is it out of the money? Well, because that 81 call doesn't have any right to brag about nothing. That's very bad English. Sorry for that. the 81 call gives the right as a contract. I'm not saying it gives you the right. I'm saying as a contract, a call is the right to buy. So the right to buy at 81 when the stock is trading at 76 has no advantage. There is nothing to brag about. Therefore, the option is out of the money. So there was no need to be concerned about the 81 call. Forget about it. This call is not going to do anything. It's going to expire worthless. And the only thing that's going to happen is that the next day after the market closes, you look at your account and the call is not there. Okay, it's gone. It does have an impact on the P&L, which is whatever you pay for the call is also lost, right? So this call was traded at $61, and therefore those $61 were lost because the option expired in the money. Out of the money. But remember, it's not about how much you made or you lost. When we talk about in the money or out of the money, we are not referring to profitability. We are referring to, do you have a risk of assignment of an or auto exercise or not? And the first thing I'm addressing now is finding out if we have a risk or not of being either assigned or auto exercise, and in which direction. And if that's the case, then we'll review what to do in that case, okay? Which was your comment as well, Maka. Maka, isn't it 2x short strikes, 1x above and below? Yes. What did they say? We had two. Yes, correct. This is correct. I mean, the strike in the middle, you got 2 plus 2, that's 4. Above, you got 2. And below, you got 2. Right? So, again, if I write down what's an iron butterfly, okay, I'm diverting from the subject a little bit, but I get your question. So, a butterfly is made of buy a call, then sell a call, sell a put, and buy a put. So, in here, you have 2 units. Above, you have 1 unit. Below, you have 1 unit. So here we have it doubled. Everything is times 2. So you have 2 units above, you have 2 units below, and you have 4 units in the middle. Okay, which is exactly the same structure. Even though I get it, when you see minus 2, minus 2, minus 2, minus 2, it gives you the impression that it's 1, 1, 1, 1, but it is actually 1, 1, 1, 1 if you write it the way I just did. Okay, so plus C, minus P, plus P. So it's 1, 1, 1, 1, which is 2 strikes in the middle. Okay, but it's 1, 1, 1, 1. Okay, so hopefully you are with me on that. And again, I will keep going now because we need to talk about in the money, out of the money. Okay, so got it. So we got this. So now, no issue with the 81 call in the sense that it was out of the money, so nothing to talk about. Okay, now the stock ended up trading at 76.19. Okay, that's where the stock was trading at, okay, on the day of expiration. And obviously, if I go back to my writing, okay, and I was to add some space so I can do a few more notes. So I guess that you are with me, that maybe I could do something like that, just to be visual, and type here 76.19, which is more or less here. Okay, so if I do it like this, okay, so now you will probably understand better, right? So 76.19 was kind of there, right? 76.19 is kind of here, which is between the 77 and the 76, and then above I got 77 and 78. So okay, so let's go ahead and look at all of those options contracts. I'm gonna make a bit more space to the right so I can push this to the right. And let's again ask ourselves the question, be ready to participate. Let's do this quick, my friends. So we concluded the 81 call is out of the money, and that was correct. So question number 2, what about the 78 call? Is it in the money or out of the money? Please go ahead, everybody, type ITM or OTM, speed of the light. 78 call, is it in the money or out of the money? Out of the money. Very good, Mark. Very good. So from an assignment or auto exercise point of view, do we have anything to be concerned about? No. This option is gone. It will disappear from your account because it expires worthless. It's out of the money. The 78 call doesn't give you bragging rights if the stock is currently trading at 76.19. So there is nothing to be concerned about, so forget about it. Next question. What about the 77 call? Is it in the money or out of the money? What is it? Okay. On Friday, when the stock was trading at 76.19, was that 77 call in the money or out of the money? So again, speed of the light, please use the chat box, type ITM or OTM. ITM or OTM. Thank you so much, my friends. You got it right. That one is also out of the money because you have no bragging rights. A call gives you, a call contract is a contract that gives a right to buy at 77. Current price is 76. That's cheaper. Why would you buy at 77? No bragging rights, out of the money. Same story. Now, what about the 76 put? Okay, what about the 76 put? Is it in the money or out of the money? So please, Sam, use the chat box, speed of the light, ITM or OTM. Is it in the money or out of the money? In the money or out of the money? The 76 put. Okay, I see mixed answers there. Okay, I see mixed answers there. You guys are so quiet in YouTube. Okay, you guys are so quiet in YouTube. Is it because it's publicly seen? Come on, guys, work with me. So it's out of the money, my friends. Again, think about your bragging rights. It's a put. Okay, right? So a put is a contract which provides the right to sell. In this case, the right to sell at 76. So is this giving you bragging rights? If the market allows you to sell at 76.19 right now, but whoever owns the put has the right to sell at 76, do they have anything to brag about if they come to you and say, hey, you sold at 76.19, I have the right to sell at 76? Is that something that has any advantage built in, or is actually a disadvantage, right? It is a disadvantage, okay? There is no bragging rights. So the 76 put is also out of the money, OTM, out of the money. Therefore, again, even though it's a put, the prior cases were calls, the same thing is going to happen. The market closes on Friday, you turn off your computer, come back next day, turn on the computer, look at your account, that put is gone. Expire, worthless, it's gone. That's it. Okay, we are not talking about is it profitable or not. We're talking about, are you going to be assigned or auto exercise on that put? No. Why? It's out of the money. Okay. So finally, the last question. Okay, and I guess that the answer now is obvious. Okay. So the 77 put, is it in the money or out of the money? Go ahead, please. Everybody, even in YouTube, you guys know the answer now. Come on. Just waiting for your answers, my friends. How are you, Ahmed? You just came at the very perfect time, my friend. This is the key question I just ask everybody. Is the 77 put in the money or out of the money? In the money. Very good, Christian, Jeff. Very good. Very good, everybody. Great. Yes. Again, think about bragging rights. Okay. 77 put provides a right to sell at 77. Whoever doesn't have the put needs to sell at 76.19. But whoever has that put can sell at 77. That's a better price to sell. So you have bragging rights. Therefore, that option is in the money. And because it's in the money, that option is now subject to either assignment or exercise. Okay, so that option is now subject to assignment. Oop, I'm missing a letter. Or auto exercise. Okay, so now what is it going to be? Is it going to be assignment or is it going to be exercise? What is it going to be? Right? And the answer depends of did you buy that option? Oh, sorry guys, I just typed it in the wrong row. Sorry for that, guys. Sorry. The last thing I want to do is confuse you. Sorry for that. Let me cut. Here we go. Here we go. Sorry guys. Why it didn't change? Cut. Did they paste it in the wrong place again? Probably yes. Here we go. So the 77 put now, let me push this to 77 right there. Okay, so that one is going to be is going to be assigned or auto exercised, and we know that because it's in the money. Okay, so all the other ones don't care. When I say don't care, I mean don't care from the point of view of risk of assignment or risk of auto exercise and the consequences of finding yourself either long or short shares. The 77 put is the only one that is a concern from the point of view of assignment or exercise because it's the one which is in the money. So now the next question, now that we know that's the one, the next question is, are you going to be assigned or are you going to be auto-exercised? Because it's a big difference, right? If you are auto-exercised, it means that you're going to enjoy the bragging rights. Okay, what were the bragging rights of the 77 put? To sell at 77. So guess what? You will find yourself short. Okay, you'll be short. Therefore, if you are assigned, okay, then you're gonna find yourself long. And the opposite would happen with the calls. Okay, I'm not sure if I need to explain that. What happens when you get assigned a call and a put? What happens when you get auto exercise a call or a put? You guys are okay with that, or you want me to explain it? Please type it on the chat box if you want me to explain it. I would assume that you guys know that. But again, if you don't, the rule of thumb to remember this is if you are auto exercised, you enjoy the bragging rights. And because it's a put, is to sell. If it's a call, is to buy. So if you are short, right? If you sold the option to someone who bought it. The one person who buys it enjoys the benefit of having bought a contract. But if you sold it, you need to deliver the benefit to whoever bought the contract and paid you the premium you received when you sold the option. So in other words, you're gonna be exposed to the opposite. Okay, so if the guy is short, then you're gonna be long. Okay, which by the way, it's probably very easy to remember because when you sell puts, they are called puts for a reason. If you sell puts, you may get the stock put to you. So now, what does it mean to get the stock put to you? Well, it means that you own it. And what does it mean to own it? It means you are long. So again, when you buy a put, if it's in the money, you get auto exercise, you end up short. Okay, let me write it down. Okay, so that way, Christian, you can have a mini summary on the screen. So if you are long a call, okay, and it's in the money, then you become long the stock. Why? Because if you are long a call and it's in the money, you get auto exercised. And auto exercise means that you get the bragging rights. And what's the bragging rights? The bragging rights of a call is to buy the stock. So then you are long stock. What if you are short the call? Well, it's the opposite, right? If the person who bought the call and therefore paid you because you sold the call to the person, that bought it from you, so then you're gonna find yourself short stock. Okay, and with the put is the opposite. If you are long the put, okay, long a put, okay, you're gonna enjoy the bragging rights of having the right to sell. So you will find yourself short stock. Therefore, if you shorted the put, you sold the put to someone who bought the put from you, someone paid you to have the bragging rights. So now you're going to be on the other side. And if that person is short, then you're going to be long stock. Okay. So this is, one way to remember it. There are many ways to remember it, but this is kind of like one way. Okay. So hopefully this helps, Christian. You indeed need cash in your account to either be exercised or be assigned. In both cases, you need cash. And by the way, the same amount. because you will end up either long or short shares. And in both cases, you have the same margin requirements to be long or short shares. It's the same. So you need the same amount to be either auto-exercise or to be assigned either a call or either a put. Same amount. Okay? Cool. So, question, ready to answer on the chat box. We concluded the 77 put is in the money, and you sold it. You are short the put, minus is short, minus is sell. So if you shorted the 77 put, which is in the money, question, will you end up long shares or short shares? Long stock or short stock? Type this, please. Just the word long or the word short. What that we do. My pleasure, Christian. Yes, Jeff, I'm reading you. Christian, I'm reading you. You guys were assigned 200 long shares. So that's the answer. The answer is long. Okay? But hopefully you understand why it's long. It's not like I got assigned, so now I know it's long, right? So why are you long? Because you were short a put, right? So the shares were put to you. You were on the other side of the person enjoying the benefit, the bragging rights of having a put in the money. And therefore, you ended up buying the shares from that guy that put the shares to you. So we can phrase that in a million ways. But again, you may need to think about it. Again, this is very basic option stuff, but it's very critical, okay? So now, so if you sold the options, it's a put. It was in the money because the stock was at 76.19. You got assigned, and because it's a put, you find yourself long shares, long stock. Okay? So that was the situation. So if you did nothing about this trade and you just let it be, so you would have found yourself somewhere, depending on your broker and how they operate and so on. Maybe on Saturday, you turn on the computer and you see you have 200 shares of stock. Why 200 shares? Because it was two contracts. Okay, so 100 shares, each contract is 200 shares. And you would see no more options for CL, but now you have 200 shares long. Minus and minus equals a plus. Makes sense. That's a good way to think about it as well. Another way to think about it is, was it positive delta or negative delta? And if it's positive delta, you get long stock. If it's negative delta, you get short stock. Again, all of this is valid as long as it works for you to remember, and you don't get confused when it's that time where the market is about to close in 1 hour and you have to take a decision and you are by yourself on your own. So make sure you are not getting confused at that time. Okay, so that's why I keep repeating this many times today. Okay, Christian, you tried to close but you were not filled. Okay, which is something that happens as we are approaching expiration. I did warn of that, where the bid size or the ask size becomes zero, and then market makers and other traders have no interest to get in on the other side of the trade to close it, not even for 1 penny, and then you cannot close it. Okay, so then we need to talk about what to do to avoid assignment if you want to avoid assignment, which was Maca's writing at the beginning of the session, which I need to discuss now. Okay, so good comment there, Christian, as well. And Maca, you closed it at 97. You closed it at 97. I'm not following 97. Cannot be the price of the stock. You mean it was the premium, or I'm not sure what exactly what you mean by that. If you could clarify, that would be good. But anyway, so now when you get to this point where the market is about to close, the whole thing is about to hit expiration date. The 77 put is gonna get you assigned. You're gonna find yourself long 200 shares. So then what's the risk? Okay, well, the risk, as you can see, on October 29, that stock closed at 76.19, right? And on the very next day, which is Monday, the stock opened at 75.99. So from 76.19, which was the closing price on Friday, to 75.99, which is the opening price on Monday, of course, that would have implied a loss, right? So you own 200 shares, the stock opens gapping down by a few cents, you close it right there, you just got a loss on the shares. Maybe the profit collected on all the options contracts before implied a profit, and when you put together the profit on the options contracts and the loss on the shares, you're still ahead of the game. So maybe it's okay, it's not a big deal. But the point is, what if the gap, instead of a few cents, what if the gap was, 20% up, 20% down? I mean, 20% up is great. 20% down, right? So now what? Now you have a huge issue. And this is where now I am okay to use the word the risk of assignment. Why would that be risky? Well, because now you are left with an unlimited risk position graph, right? Which is when you are 100 delta, which what we call hard deltas, meaning stock shares, right? So if the stock drops 1, you lose 1. If the stock drops 5, you lose 5. There is nothing to mitigate the risk when you own shares. You can even use stops because the market is closed. So if you get a gap, your stop will be hit, but next day after the gap. So there is no way you can control your risk. So when you got shares combined with options, like we've done many times with double diagonals and things like that, not an issue, because the remaining options contracts combined with the shares mitigate the risk. But when you are long shares and you got nothing else, you are exposed to the risk of being a stock trader, which is unlimited risk. And if you got a 20% gap, you're going to suffer 20% loss on those positions. So not a good idea. Therefore, you want to avoid assignment or auto exercise in a case where you would be left in a position where it's only shares, either long or short, it doesn't matter. If it's only shares, you have no protection and you want to avoid that. So how can you avoid that? Well, the best idea is to not to get to a point where you don't know what to do. That's the best idea. And therefore, the best idea is to act early. Okay, in my case, I closed this trade when the stock was trading somewhere around 77. I think it was 76.90 something like that. Okay, so earlier on that Friday, okay, so the stock opened trading at this price, which was basically 77. Okay, and moved a bit higher, a bit lower, somewhere in that range. I closed the trade, and my net profit on the trade was like, I think it was like $30 something overall for the whole position with all the contracts and everything else. So basically, I converted a losing trade into a profitable trade. So that was a good execution there. Okay. Now, if you did nothing and the stock went down, well, you got two problems. Number one, you are moving away from the 77 strike, which provides that triangle-shaped risk profile in the case of an iron butterfly that we talked about yesterday. And therefore, the more you move away from that midpoint, the less you're going to profit. Okay. And that's a problem by itself. But on top of that, if it's on the expiration date, you are getting closer and closer and closer to that time where no one wants to be on the other side of the trade, because why would someone buy a contract for 1 cent when there are 10 minutes left to expiration? And not even the market makers. And now you get to see that you place an order and you don't get filled, and you go into expiration, and now you're like, what do I do now? And the answer is you cannot do anything because the option has expired, so you are assigned, right? So again, advice: first, act early so you don't get to a point where you're so close to expiration that now you cannot exit. Okay, that's advice number one. Advice number two: what if you could not? What if the stock the prior day was trading, let's say the stock the prior day was trading, somewhere here, 80.5, right? And next thing you know, that stock today, gap down here at 77, which is like, this trade was going to be a sure thing loss. Next thing you know, this trade now is back in the range. Good news. But guess what? Let's say this happens 5 minutes before the close. So there is no liquidity for you to exit. Okay. Well, you're going to get assigned. Okay. Good news. You're going to get a profit on the trade, but you're going to get assigned shares. And then you are left with stock shares. And if the stock gaps against, you're going to get an extra loss on Monday. So how can you avoid the problem of not being able to exit if you were not able to act early? Okay. So basically you got two solutions, which is what Micah mentioned earlier. Okay. So first is to understand what the assignment is going to do to you and do the opposite with stock shares. So if the assignment is going to get you long, which is what we said, short put gets you long. So what you could do is, let's say 5 minutes before the market closes, you can go ahead and short 100 shares. So you short 100 shares 5 minutes before the close. So instead of having weekend gap risk, you have 5 minutes risk of the price moving against you, meaning that you short 100 shares and during 5 minutes those shares go up, giving you a few extra cents of loss during 5 minutes. By the way, maybe you do it 2 minutes before the close. It also depends on the liquidity. You could certainly look at the bid-ask spread of the stock in this case, and you will see how the closing time of the day approaches. You will see the bid-ask spread also widens. So you don't want to suffer too much of spread on the stock either. So that's why I said 5 minutes. Again, if you're trading, let's say Microsoft, super liquid, you may wait 15 seconds before the close and you still get filled. So it depends on the stock that you trade, but basically that little amount of time that you shorted shares before the close, that will give you again, little amount of risk of the stock moving against you. But now you neutralize the gap risk on Monday, because what happens is that you are short shares, the market closes, you are assigned, and you are put shares long at 77, which will neutralize your short shares at whatever price you got them. Maybe at, I don't know, maybe at 76.8 or at 77.3, whatever price that was. Long shares and short shares could not coexist in an equity account in the US based on the regulation. And if you are short and you buy shares, which is the same as being assigned, the trade is closed and basically you are flat. Okay. So one way to avoid the gap risk is to end up being flat by shorting 5 minutes before the end if you are going to be assigned on a put, or by going long 5 minutes or less before the end on expiration if you are short a call and you are about to be assigned the call, which being assigned on a call would get you short, right? If I go back to my notes, being short on a call will get you short, so you can buy long shares 5 minutes before the end. If you're short on a put, you're going to get long stock, so 5 minutes before the end, you can short shares. By the way, when it comes to shorting shares, note of caution, sometimes you may not be able to because the stock is hard to borrow. That could happen, okay? Depending on brokers or which security you are trading, so that could happen. So now what do you do if you cannot short shares? Okay, well, an alternative is to buy a put, okay? To buy a put. Buy a put which is in the money, right? Because if you buy a put which is in the money, that put will auto-exercise, correct? And that put which auto-exercises combined with the one that will be assigned is like being long and short, and they neutralize each other. So it's the same thing. Now make sure you buy a put which is in the money, so it auto-exercises. Don't buy a put which is out of the money, because then it expires worthless. Okay, that's the case of the 76 put. It expires worthless. That does nothing. But if, let's say, and in this case, don't wait 5 minutes before the end, because again, with the options contracts, you will have problems to get filled, right? But again, if you get an option which is fairly in the money, so let's say you get, I'm just going to use the 79 put, for example. So if you get the 79 put, like maybe 30 minutes before the end of the trading day, so you attempt to buy the 79 put, okay? You got, and let's say the stock is trading at 77.5 at that moment in time. So that option got $1.50 of intrinsic value, right? So what can you do? Well, you can go ahead and buy that option, okay? You won't pay 1.5 because there's still 30 minutes of time value left. So that option may cost you 155 instead of 150, okay? Or maybe the market makers are a bit tricky and they charge you 165, whatever. It depends on volatility and other conditions too. But you will need to pay just a little more than the intrinsic value, and the difference will be lost. So if the intrinsic value is 1.5 and you pay 165 for the put, so you will lose 15 cents, which, let's face it, is the same as shorting shares 5 minutes before the end and having the risk of having the stock move against you for 5 minutes. You may lose 15 cents. Is that making sense? So it's not that much different. It's about the same, guys. So you can buy a put which is slightly in the money, and you would have to pay a little bit of extrinsic value, time value, just a tiny bit, maybe 5, 10, 15 cents, whatever, depending on the stock. But now what happens? The market closes, and the moment the market closes, right? The moment the market closes, your 79 put will auto-exercise. your 77 put will be assigned. So you will be short at 77. You will be long at, you will be short at 79. You will be long at 77. So that will neutralize and make you flat. You will have paid whatever amount for the put. And if the current price of the stock is 77.5, well, actually that's a bad example, guys. Sorry for that. Because if the current price of the stock is 77.5, the put would not assign. The put actually would expire worthless. It would be out of the money. Bad example. Let me rephrase it so I don't confuse you. Sorry for that, guys. Let me do this again. Okay, so again, let's use the real numbers actually. Okay, so the stock expired at 76.19. Okay, so let's go with that number. So let's say that a few minutes before the close, like 30 minutes before the close, you want to buy the 79 put. So how much is the intrinsic value from 79 to 76.19? Okay, well, it's almost $3, right? It's almost $3. So let's say you will pay $3 for this put, okay, 3.00, okay, and now market closes, right? So what happens? Well, you will get short shares at 79. You will go long at 77. So that will flatten the position. You will be flat. Because you sold at 79 and you bought at 77, okay, you created a profit of $3. But because you had to pay $3 to get the put, so the put you bought cost you $3, but then the profit you created, which is the distance between strikes, is $3. So basically, you manage to flatten the position by auto-exercising yourself and allowing the assignment to happen without finding yourself naked shares, exposed to the gap risk on Monday. So, in other words, and Maka, I want to ask you an exercise if you don't mind, because at the beginning of the session you typed, I'm looking for you, you type, where was it? Stock below or above the short strike. Yeah, you said to avoid buy shares or buy a call if you are below the short put, and you said sell shares or buy a put if above the short call. So I would like you to rectify those statements, and if you don't mind, to type it on the chat box one more time, and that way I could confirm that you are with me. And selfishly, I'm gonna save myself some typing by having you all watch the chat box, if you don't mind, Maka. I think it's a healthy exercise for everybody, because I've been explaining it. So now I would like everybody to think about it. And when you see what Maka is about to type, I would like all of you to evaluate it, think about it in your mind, so you kind of internalize it. So when you are in that position, about to decide what to do, so you know what to do. So in this trademark, well said, you needed to sell 200 shares to find yourself flat over the weekend when your broker processes the assignment, and therefore get you out of your short shares by assigning you long shares when the shares are put to you. Wow, what a long conversation, my friends, but this was indeed very needed, I believe. So I believe, Maka, you are probably writing that. Okay, let me know if you are writing that. Okay, we surpassed, I'm just looking at the time, by the way. Oh my God, we surpassed by 30 minutes the theoretical time for our sessions to be over. I apologize for that. So you buy shares or you buy a call if you are above the short call. Correct. This is correct, because if you are above a short call, you are about to find yourself short. So in order to neutralize the short and flatten yourself out, you would want to either buy shares or buy a call. If you buy shares, just do it like 5 minutes before the end or less. If you buy a call, don't make it too difficult for yourself. Maybe you do it 30 minutes before. So at least, you find some strike with a little bit of bid or ask volume and size, and that way at least you can get filled. Because if you wait, you're like 2 minutes before the end, You may not even get filled on that call, right? So be careful there. And then, Maka, thank you very much. You sell shares or buy a put if you are below the short put, which was the example with CL, because when you are short a put, you are about to get put stock, so you will find yourself long. So to flatten the upcoming stock in your account, you short shares or you buy a put, which will auto exercise and short shares for you. And then those long shares that are being put to you will flatten you out. So yes, this is the right answer, Maka. I hope this was good for everybody. Please give me your feedback, guys. We are done for today. Give me your feedback. I was, again, I was indeed planning to have a lecture today. Like it happened often, to be honest. I want to give you all the details, and I know what is it to learn how to trade options. So I want to make sure that when you are by yourself at home and you are doing the trades and thinking about it, you have the ingredients that are needed to think about it properly. So I like to phrase and rephrase things in different ways, so that's well understood. And often, I use just a little bit, maybe just a little bit too much time. Okay, but you guys, I guess, know me, and I guess I can be excused. But anyway, I'm eager to run a few sessions for you guys with intense trading. Okay, so we need to focus on that too. So you are flattened, Maka. In addition, if the stock is close to the 77, how would you know if it's end up there or in a loss? If you may still move even with 5 minutes left. So I think it's best to close whenever it gets close to the max profit. Yes, Maka, because that's exactly, again, the concept was ideally you don't find yourself in that situation that we are discussing and you act early. Okay, you act early. But now, what if something happened? I don't know, your computer got issues yesterday. That was the day for you to act. Now your internet dropped today, and the internet is only back, 10 minutes before the close. And now you see the stock is trading at 77.01 and going down 76.95 and up 77.05 and down 76.98. And it's like, oh my God, what do I do? Do I go long shares or do I go short shares? What do I do? Okay. Do I buy a call or do I buy a put? What do I do? Well, that's a very tough one. That's very, very, very tough. And the reality is that if you find yourself in that position, it's probably going to end up with, some sort of a gap on Monday that, depending on how lucky you are, you either profit from the gap or lose from the gap. My attempt, which may not work in many cases, but my attempt there would be to buy a strangle, buy a call and buy a put. And do it at the money. Okay? Do it at the money. So buy a call and buy a put. That would be my attempt. So if it goes higher, okay, I'm going to get out. But notice that buying a call and buying a put really is closing that. Okay? And when I say buy a call, buy a put, in this case, we buy two calls, buy two puts in this case. But that is closing that. So I would persist to try to get that filled. Okay? And if I cannot, okay, then I only got one choice, which is to wait for the very, very, very end. And if the stock is teasing me, I mean, I had, one case, and I believe I commented that in the room not too long ago, where a stock closed exactly at 0.00. I never had that in my whole trading career, but it happened maybe 2 months ago. I remember I commented in the room. So you would just wait, and like, a few seconds before the close, you would just have a bet and go, okay, I'm going long. Okay, I'm going short, because you are above 77 or below. What's the issue? The stock may be hard to borrow, and if you have to go short, you cannot. So then you're going to be assigned, and then you may have a gap. My friends, you cannot do anything there. Okay, that's what it is. So the alternative, okay, is to continue to do that using post-market, which is not going to be that different, because you may be like, oh, yes, I can do it post-market, so then I don't need to be worried. I just need to wait for the closing price. Now I know it's 76.18, so now I know that the right choice is to short, so let's short using post-market data. Well, yes, you could do that. But normally when you use post-market data, you're going to suffer pretty important slippage, and that is almost as the same as having a small gap on Monday, like it happened in this case. So again, there is a moment in time in trading, or many things in life, where we cannot predict the future, and there is a moment in time where we have to take an action. So what's the best action? Not to find yourself in a late move, right? Where now you really need to get creative. Okay, so I gave you the various possibilities if you have to ever get creative, which I had, and I'm sure that you will at some point. But because we are human and sometimes we make a mistake with the date, or we have a computer issue, or whatever, the things happen. So you will, believe me, you will. There is one day you'll find yourself in that position, but have a plan to never find yourself in that position and act early. Okay, that's my point. So, Christian, super for me to learn. Thank you so much. Joe, what's like to sell an in-the-money put near expiration? What's like? Well, it's an action where you get paid nothing. So if you got an option trading at 2 cents and you sell it, then you get paid 2 cents. Okay? But remember, if you are trying to do that, Joe, okay, I'm just guessing, okay, maybe I'm wrong, but I believe this is what you're thinking. You're thinking, look, I'm about to be put short shares, okay? I'm about to be put short shares, sorry, long stock. So I want to short shares, okay? So what you're thinking is, what about I short a call? Okay, what about I short a call? So I find myself short stock, and that neutralizes it. Well, here's the issue. If you are short the 77 put and you sell the 78 call, first of all, good luck doing that because it's away from the other money strike. It will pay 2 cents. Probably no one wants to sell it to you. Probably pay 0 cents. So good luck with being filled. But now let's say you get filled. Well, guess what? This option is out of the money. So you won't get a sign and therefore find yourself short stock. You will find long stock, but not short stock, right? So it's just like a 77 call. It's not going to help you either. It's out of the money. So it's not going to work. So what could you do though? Well, what you could do, but again, because it's far, probably you won't get filled. You may not find a bid size if you do it too late, which is to sell the 76 call. Okay. If you sell the 76 call, okay, so now you will put the stock at 77. You will find yourself long at 76, sorry, short at 76. That's a disadvantage. You lose $1 by doing that, but that should pay you $1, maybe $1.02. So that would be okay. Okay. But the risk of doing that is, what if in the last 5 minutes, okay, then the stock rallies and goes above 77? Okay. What's the problem? Well, now you get assigned 200 shares on the 77 strike, and you get assigned another 200 shares on the 76 strike. So now you are short 400 shares instead of flat. Okay, and the reason is because you sold instead of you bought. So I used the term creative before, which indeed you have to get creative when you get like 5 minutes to the close, but careful with getting creative with short units, because then you get risk of assignment instead of the beauty of auto exercise. Remember, the auto exercise is a bragging right to offset the problem of being assigned stock and be naked stock. But if you short an option and you short another option, you may end up, double assigned if the stock moves fast before the close. So careful. Okay, careful with that. I would not suggest it. Okay, but anyway, it's a good thought. It's a great question. It's a good conversation, I guess. It gets you thinking. It's important to understand the pros and the cons, and there may be a case where maybe some option is, for whatever reason, have plenty of premium and the risk is worth it. So you could do it and it would work. But again, keep that in mind. Okay, if the stock moves very quick, now you may have 400 shares instead of 200. So careful with that. Anyway, my friends, done for today. 23 minutes late. Sorry for that. I guess it was needed. Thank you so much for your participation, guys, for paying attention. This is a very basic subject, but at the same time, it gets you thinking, isn't it? So hopefully this is clear. Make your notes and please use the question page if you have any question about this and phrase it there. Actually, that would be great. Or even if it's not a question, if you want to do a summary of what you learned today, that would be very nice and very helpful to the community. Like I'm thinking of you, Maka, for example, if you don't mind me to utilize your example in the session today when you started. You had very good notes. I think those were a very good summary of You know how not to get confused? If you are about to get confused, the market is moving fast, you have to take a decision, and you're like, wait a minute, I'm gonna get confused. Let's look at my notes. So well done to approach it this way. So if you guys feel like sharing that on the help page, go ahead and do that. Can we look real quick what I did to PY? You close at 77 and 97. So the whole trade was closed at 97. That's what you're saying? Please confirm that to me. Was it the 77 that was closed at 97, or the whole trade was closed at 97? Or you closed the 77 and 97 and you let the rest expire worthless. I guess that's what it is. So let's do the math. So this trade cost you, let's do the math correctly. So 86 yes, 86 plus 10 cents minus 12 cents and minus 119, and that's times 2. So you got 70 cents of credit, and then the 81. Oh, sorry guys, I'm looking at Pfizer. Oh, my bad guys, sorry for that. I was looking down at Pfizer instead of looking at CL. I should be looking here. Okay, that's where I should be looking at. Sorry for that. Let me start again. Okay, so 76, 77. Okay, so I'm going to start with 131. That's what you paid. Then you have 61. That's the lonely 81 call. Sorry, let me do this. 131 plus 18 cents for the 78 call. I'm going to take those two first, and the reason why is because those are times 2. So 131 plus 18 is 149 minus 173 minus 0.40. That's the credit collected, so this times 2. This is the total credit collected minus the 61, I should say plus the 61 cents that we paid for the 81 call, the lonely 81 call. That would be a net credit of 67 for the trade. Okay, so you collected a credit of 67, and when you close the trade, you paid 97. Okay, so you paid more to exit than what you got when you entered. So if those were your numbers, then you would have lost $30 per contract. That would be your net result, Maca. Yes. Okay, so putting on the side that your values, the prices that you got filled at, may be slightly different than mine. So this would be the math, and this would be your result. Okay, so could you please confirm that you lost around $30 per contract, something like that? Because in normal cases, I would just right click and go for the risk graph, but I cannot, because I cannot graph something that doesn't exist anymore. Okay, so you see, it's not there. That's why I had to do the math with the calculator. Okay, got you. Perfect, everybody. Thank you so much, my friends. Again, intense session today, 1 hour and a half. My friends, keep up the good work. I will see you on Sunday with the top session, and we continue then. Take care, everybody. Bye-bye.